market and equity markets are in the green today as we kick off a fresh trading week. And this trading week is a pretty busy one. Here at home, the Bank of Canada will make an interest rate decision on Wednesday, and our neighbors to the south will report CPI as well as PPI later on this week. So with the US economy continuing to show resilience, our next guest says that the US may be transitioning from late cycle back to this mid-cycle vibe that he has been discussing. We're going to dig in there. Joining me this morning to share his latest market thesis, including the macro themes moving markets for this week, is Fidelity Director of Global Macro, Jurrien Timmer. Welcome. Great to see you.
Good morning. Happy Solar Eclipse Day.
Happy Solar Eclipse Day. All kinds of interesting thoughts come out around this day. And the kids are home and the glasses are around. We want to invite everyone to send their questions in, certainly throughout the next half hour for Jurrien Timmer. Tell us a bit, I mean, should we go there first on just wrapping up the fourth quarter? Here we are nicely into the beginning of the second quarter. Do we want to go back to sort of what we saw worked tremendously, Bitcoin?
Yes. So let's start with slide 9. So yes, the first quarter is in the bag. It kind of, we kind of picked up where we left off in the last quarter of last year. But you can see, as has been the case for a while, Bitcoin mega cap growth on top, Japan right up there. Japanese equities have been on fire. And at the bottom, it's sort of, the usual suspects of bonds and commodities. And if we rank them all up, if we go to slide 8, you can see it maybe a little bit easier. And so
it's at the bottom. Oh my goodness.
Yeah. Exactly. So, once in a while, you got to update the scales when you start adding Bitcoin to charts. So it's been sort of the same thing for the last 4 or 5 months. So late October of last year, the stock market really kind of reached the breaking point as bond yields pushed up to 5%. And that was, the market sort of cried uncle. I don't know if that's a Canadian expression as much as a US expression, but that was a breaking point. The market kind of like looked into the abyss saying, oh my God, rates are going to stay high forever. And then obviously the Fed pivoted, rates started to come back. Janet Yellen very cleverly changed the mix of issuances from the Treasury to switching to from bonds to T-bills. That made big improvements in the repo market, which then kind of caused liquidity to flow. And actually, if we pull up slide 12, you can see that liquidity. So it had all kinds of knock-on effects. So this is the total liquidity indicator that we've shown in the past. Fed balance sheet minus the Treasury's cash balance at the Fed minus reverse repos. And so there was a chain reaction happening. And since that late October sort of abyss moment, the S&P 500 is up about 28%, and the S&P 500 equal weighted index is up 28% as well. And so that brings me to slide 1, which is one that we've shown in the past, showing, the market and the internal breadth numbers. This is the cap weighted index, but you can see, almost 90% of stocks above their 200-day moving average. It's come down a little bit last week because the market had a small correction, but still, for a market that was in late cycle for all of 2023, mid-cycle vibes have returned. It looks like the Fed has landed the plane safely, at least at this point. And so, we've had some really good momentum in the first quarter, including new all-time highs for both the cap-weighted and equal-weighted index for the first time in 26 months. So a lot of milestones achieved in Q1.
Still kind of fascinating when you look at the overall sort of positioning. We can come back to the 60-40, which we've talked about quite a lot over the first few months of the year. There's some new things in the 60-40. That's sort of what I want to get to ultimately. And it has to do with the bond story and where you've seen bonds. Bonds have been an amazing source of income for people for the last many months.
So let's pull up slide 7, which no one's going to be able to read the numbers in the slide, which is fine. It's really just there as a heat map. But that's my correlation matrix over the last 12 months. So it's pretty much every asset class that I track against every other asset class. And you can see, obviously, red means it's positively correlated, and the redder it gets, the more positively correlated it is. And blue means negatively correlated, and kind of whitish is uncorrelated. And so it used to be that bonds, of course, were very negatively correlated, and they were that way for the last few decades. I can, we call that the Great Moderation, when inflation was low. The volatility of inflation was low. It was the zero interest days, the days of QE. And so, that was when the Fed and other central banks wielded a lot of power over the markets. In the last 4 years since the pandemic, I think there's a regime change underway from monetary dominance to fiscal dominance, where what the Fed and other central banks are doing has less of an impact. I mean, think about how much the Fed has raised rates and how little it has done to the economy. And I think the answer is that the fiscal side of the house is now wielding a lot more power. And this is why, for instance, when, and I'll get back to bonds in a moment, but when we look at the Fed, and the Fed chart is slide 25, and we look at how much the Fed has tightened, how restrictive it presumably is, yet at the same time, the monetary base, the money supply is growing. And that liquidity chart that I showed earlier is rising. And so this is the power of the fiscal side. And the reason this is important, if we go now to slide 27, when we look at the stock market, the equity PE ratio, and we compare that to the bond valuation. So if we take the bond yield, flip it upside down, you get a PE for bonds, basically. That's the black line in the chart. The purple line is the equity PE for the S&P 500. And you see the vertical line there. That was around circa 2000 or so. To the left of that line was an era of positive correlations between stocks and bonds. And back then, we used to talk about the Fed model, which was one of Alan Greenspan's favorite indicator. And when yields would go up too much, the stock market would, it would break something, and the stock market would get under pressure. And of course, the 87 crash was the most famous episode of that. So yields would go up, and the stock market would ignore it until we got to that uncle point, and then the stock market would correct. So that was the days of positive correlation. Then, of course, the 2000s happened, the Great Moderation, and the last 20 years or so until COVID was a period where falling yields would have a negative impact instead of rising yields. Right. So my sense is that we're back to the old days, which again doesn't mean you shouldn't own bonds, but you own them for income, and the real return is positive again since the Fed has raised rates. So that's all good. But if we're going back to, if we're back into a positive correlation regime, then we could see what we saw actually happen in October, which is yields go up, the market kind of ignores it for a while, and then they go up to the point where the market cries uncle, and then something breaks. And that's what happened in October. And so it's just a different sort of world order of what stocks and bonds do and how they react together, and how we can build a portfolio that is more diversified. And that kind of brings me back to that correlation matrix that, bonds are no longer blue, they're now red. So they're now positively correlated. So the best we can do in terms of diversification is to find uncorrelated assets, which tend to be these alternatives, liquid alts, hedge funds, equity, long, short, managed futures. And of course, we have a number of these products in Canada. And the thing that is the most negatively correlated, or the only thing that's negatively correlated at this point, is actually the US dollar. And now it's not exactly easy to—
Is that a timing thing? I mean, okay, this is what it says in some of your notes that there's—
And so it's, so is the dollar an asset class? It's a currency, of course. And so it's easier said than done to say, okay, I'm going to put my money in dollars, because then you have to deal with interest rate differentials and all that stuff. But for Canadian investors, it's an important message that just being in dollar assets is a diversifier against your home country. So the new 60/40 to me, still has bonds, but fewer of them. And you own them not for diversification, but for income. And you still obviously have equities in there. Equities are the proven compounder of all time. But then you start playing around with other stuff, some gold, some Bitcoin,
In the
some
40.
tips.
In 40.
I would say you borrow from both. So for me, and again, this is not investment advice. I'm not
Yeah.
but this is just my back of the envelope. I say instead of 60-40, 50, 20, and then 30% in other stuff, including cash, because cash is competitive, including tips, high yield, commodities, gold, Bitcoin, and then these kind of liquid or even illiquid alts. I mean, commodities, gold, and Bitcoin, I consider them as alts as well. But so I think just kind of being more creative about what's in a 60-40 to anticipate or react to a world where bonds are no longer negatively correlated. That's kind of, I think that's been the case for the last few years, of course, 2022 being the primary example of that. But I think that could well be the regime going forward. And, maybe we pull up slide 19, that question of fiscal dominance, when the US government, and the US is certainly not the only guilty party here, but we're running deficits of 6, 7, 8% of GDP at a time when the economy is expansion. We're not at war, or at least not overtly at war. And meanwhile, the debt has increased by 11 trillion just since the beginning of the pandemic 4 years ago. And the Fed is no longer the buyer of first or last resort, right? I mean, the Fed's balance sheet has shrunk by $1.5 trillion now since 2022. And so it makes you wonder, what is the right level for bond yields? We're at 4.43 today. That's around fair value as far as I'm concerned, but I could see them going to 5. I'm certainly see them going to 5 before they go to 3.5, unless we're in a recession. And so again, it's a new regime potentially.
It's really quite fascinating, and the options that ultimately can be part of this new regime.
Yeah.
Should we talk a little bit more about Bitcoin, because it is one of them?
Yes. Well, let's start, if you don't mind, with gold. I know gold is near and dear to Canada's heart as well, because part of this evolving puzzle of changing correlations, speaks to gold, which again is up another, 20 basis points at 23.50 today. But if we go to slide 16, gold is moving up, even though the dollar is not moving down. And historically, they've gone in opposite direction. And gold is moving up, even though real rates are positive, which is another thing that typically in the past hasn't always happened, right? So, and again, I go back to the monetary versus fiscal dominance. In an era of monetary dominance, real rates is the main driver for a lot of markets. And I'm not saying that real rates are not relevant, but you can see that real rates, which are on a reverse scale in the orange, are becoming less positive, but they're significantly positive. And you would argue gold should not be doing well. But the
so
reason
what is the worry? Oh, sorry. I was just saying, there must be a worry of some sort for gold.
Well, so I think gold has become a play on fiscal dominance, and you can see that in the purple bars, which is rising monetary base. So the monetary base is now growing at 11% per year, even though the Fed is quite restrictive. And so that's a conundrum. And I think going back to slide 19 for a moment, there's a lot of debt being issued, and I don't think there's any chance that deficits are going to go away, because the government's now spending $1 trillion on debt service, and who's going to pay for that? So my sense is that as real rates have now turned positive and debt service continues to grow, ultimately it's likely to become inflationary, certainly from a monetary perspective. And that, I think, is what gold is responding to. And just to kind of connect the dots between gold and the dollar, if we go to slide 22 for a moment, if you take the price of gold and flip it upside down on a chart and you compare it to the dollar, typically they're inversely correlated or positively correlated if you flip the scale upside down. And you can see how gold has gone, really gone up a lot, and the dollar has not moved. And so that's a really interesting dilemma, which I think can also be explained by this fiscal dominance. And just to kind of drive the point further, if we go to slide 23, this is one of my famous wonky scatter plots that shows the 10-year real yield on the vertical axis and the price of gold on the horizontal. And the gray dots is the kind of the last 25 years until 2022, when kind of this new fiscal world order began, or really 2020 with COVID. And you can see that there is a pretty reliable negative correlation between real rates and the price of gold. The purple bars is since the pandemic started, and the size of the dots shows the amount that the US government is spending on debt service. And you can see that there is, in my view at least, a clear regime change, that gold is now marching to the beat of a different drummer. It's no longer real rates, but it's now the fiscal dominance component. And because I know you and many of the followers are going to ask about, oh, what happens if we put Bitcoin in that chart? So let's go to the next slide, 24.
How did you know? Yeah.
I know my audience. So 24 now shows Bitcoin instead of gold. And you can see that there really isn't a negative correlation, just because Bitcoin has all these other elements going on. But you can see it's a not completely dissimilar chart in terms of Bitcoin going vertical after, I mean, it's been going vertical for a long time, but especially vertical as this fiscal regime changes, and despite the fact that real rates are now positive. So to me, Bitcoin and gold are new ways, or not new ways, they're just ways to protect against fiscal dominance and the monetary inflation that will likely follow. And if I could kind of close the loop with slide 20, again, coming back to the dollar, because obviously dollar is very important for Canadian investors.
But I have to ask here, is the currency debasement story in there? I mean,
so that the de-dollarization, the currency debasement is obviously a very popular narrative among the crypto folks. I am not in that camp. I think the dollar has been strong, or at least stable. And if you go back, and I don't have that chart today, but if you go back to the real exchange rated dollar, going back to the 1960s, since the fiat era began, it has really held its value quite well, even though the percentage of dollars in global reserves has gone down. It's down to about 58%. So that is de-dollarization, but it's not coming at the expense of the value of the dollar. And I think what's going on can be seen in this chart. You can see dollar's pretty steady. And in the bottom, I show the Fed's policy stance in the orange. So that's the Fed funds rate minus the TIPS break-even rate. And in the purple is the fiscal budget balance, deficit, usually surplus sometimes. And you can see that the monetary and the fiscal are diametrically on opposite sides of the ledger. And that's something we haven't really seen in a while. And the other time when that was happening were generally periods of dollar strength. And you think about it, right? The fiscal side is goosing the economy, creating a lot of economic growth, while at the same time, the Fed is attracting capital by keeping rates high. And so you have strong growth and high rates, that's going to attract capital, and I think is an offset to what otherwise would be currency debasement. And so I'm not really kind of on board with the currency debasement. And also there's some real chart crimes committed on Twitter and elsewhere, where people will deflate the price of something not by the CPI or the PCE or some inflation metric, but by the money supply, which doesn't make any sense because they figure the quantity of dollars is X and what you're getting is Y. So therefore I'm going to deflate the S&P by M2. And to me, that's a chart crime. So I think, the dollar remains pretty resilient here. Now, if the Fed ever were to pivot hard by lowering rates, then
dollar.
I think that could be different, right? And if we, and actually I can show that slide 21,
We've got
throwing
a
a lot of
bunch of
slides at
questions
you.
coming for you here,
Yeah,
but
let
when
me
you're
let me do this slide and then we'll go to the questions. But in a way, like if you look at slide 21, it's almost like the dollar is being held up like a marionette, right? So that's the 2-year yield in the purple. And again, that 2-year, those high interest rates, high, not by historical standards, but higher than what we're used to, are providing a counterbalance to what otherwise would clearly be dollar debasement from the fiscal. So, okay, so I'll stop talking and we can go to questions.
No, it's so brilliant because we've got a Bank of Canada decision and, and that's a big, is it a worry? It's certainly one of the issues for the Bank of Canada. What will the dollar do our good dollar do if you start taking away the interest rate hikes? Okay, so here are a bunch of questions. So what happens here into markets if inflation and jobs stay high and the Fed doesn't lower rates this year? So this is also, I think Neil Kashkari was talking about it last week. There's been lots of voices on this.
Yeah, so why don't we pull up slide 11? It's a good observation. And if you remember at the beginning of the year when we had that big pivot party going into year end, we were very clear saying, the market's over its skis in terms of, not in terms of where the market is, but what it's expecting from the Fed. And so if you look here, you look at 3 different inflation metrics, the core PCE year over year, core PCE 5-year annualized, which is the blue, and the what's called the super core PCE, which is core PCE minus housing, which of course is a very much a lagging indicator. And all 3 of them are kind of in that 3 to 3.5 range. So the way I think about what should the Fed do, the economy so far is soft landing. We're kind of getting back into mid-cycle. So that doesn't mean, so that does not warrant a lot of easing, of course. Also inflation, if 3.5 is the new 2, then that changes what a neutral policy would be, right? So if neutral for the Fed or any central bank is inflation plus, let's say, 100 to 150 basis points, right? You generally aim for some positive spread over inflation or over R star. Then you're looking at probably 4-ish as the most that rates can be lowered, and we're at 5 3/8, so that does create some room. But inflation is proving to be sticky. We're getting the CPI in a couple of days, so we'll see what comes up. But inflation is no longer really moving down very much. But the good news for the stock market is that we have good earnings momentum now, right? So earnings season is starting up next week. Slide 17 shows that we're poised for another positive quarter of earnings growth. So the fourth quarter, which was released in January, showed pretty good growth, 8% year-over-year growth coming into this first quarter, which usually starts the second week of April. We're starting at a 4% growth rate, but usually there's a bounce of about 300-400 basis points. So we're likely going to see another 7 or 8% growth. And to answer your question, the reason why that's important, because if you plug in earnings growth in the numerator of a discounted cash flow model and interest rates in the denominator, when earnings growth, the numerator, is very weak, the fair value, the present value of future cash flows, is very sensitive to changes in interest rates. And that's why the market last year, when earnings were still modestly falling, the market was so obsessed with, okay, when is the Fed going to cut? How much? When? Because it needed those rate cuts to make the valuation work. But now earnings are growing at 10% year over year, more or less. The forward estimate is growing by that much. And that means that the DCF needs much less heavy lifting from the denominator side, the rate side, because the numerator is doing the heavy lifting. And so that's a good piece of news. So the Fed really doesn't need to cut rates, maybe not at all, or maybe not more than a couple of times. And again, it's the earnings side doing the heavy lifting now. And again, we go back to the fiscal dominance, that a lot of liquidity is being generated from the fiscal impulse, even though the monetary side is restrictive. So it is really a changing puzzle.
Okay, there's a couple of really interesting questions here, and I think we have time for both of them. One is most of the negative correlation of alts due to their inefficient marking to market? I mean, I guess in an ETF environment, you are talking about that, but I'd take that on.
It's a great question. So first of all, these alts, liquid or illiquid, so, managed futures, absolute return, equity, long, short, things like that. They're not negatively correlated, but they're uncorrelated. So if we pull slide 7 back up, those are the white boxes. So they're neither red nor blue. So they are uncorrelated assets. So they have a correlation of near zero, give or take. And part of it could be, that they don't mark to market every day, but there are liquid versions of most of these, right? So you have ETFs and other daily liquidity vehicles for long short. I mean, we have some of them managed futures, but generally the pie gets bigger in terms of selection if you go from liquid alts to illiquid. There's many more to choose from. They tend to be better behaved, but they still they mark on a delayed basis, but they still have daily returns. They're just not as liquid. So I don't think it's a matter of delayed pricing or anything like that. It's just the nature of the beast, right? If you're a long short, then you are creating portable alpha and instead of just beta. And so if you get a good stock picker, a good portfolio manager, hopefully you can pick those stocks regardless of whether the market goes up or down. And of course, managed futures is another animal, but that's a trend following vehicle that will go into any market, maybe in hundreds of different markets, and will just jump on whatever trend is going on. And that was a big lifesaver in 2022, for instance, because both stocks and bonds were going down. But the dollar was strong, and so these managed futures will just go into whatever is working, and it almost provides a natural mean reversion against being in these big beta providers.
That's so interesting. And portable alpha, I feel like that is your phrase of the day. I love that. That's fantastic. Okay, let's see if we can get this question in. With gold versus dollar effect being inflationary, are you saying that central bank rates are going to rise again?
I don't think they will rise again, but it's always a risk, right? And what happened, not to go back to the 60s analog, which we talked about in recent weeks, but in 1966, the market weakened. There was kind of the threat of a late cycle, slightly recession vibe. That was during the guns and butter era. So the government was very concerned about the Fed not being too restrictive. And so the Fed pivoted at that point, prematurely, it turns out, and inflation came back, the economy came back, and the Fed not only had to reverse that pivot, but then actually raise rates on top of that. And then we did get the actual recession in 1970. So the recession was averted in 68, or 67, I should say, but it did come in 69, 70. And so that is a cautionary tale to, this pivot party. Let's not, count our chickens too quickly. And I think the Fed is aware of this. And I think one of the reasons the Fed has not pivoted and maybe won't pivot is because it does not want to repeat the policy mistakes of the 1960s and 70s, which is a good thing because the Fed at that point, both the fiscal and the monetary side in the 60s and 70s, they were asleep at the wheel. Like no one, I mean, it's not like they weren't paying attention, but obviously they let the great inflation be unleashed. The Fed, I think, is rightfully leaning against fiscal dominance by keeping policy tight. And the consequence of that is that both the dollar and gold are doing well, which typically doesn't happen together.
It's such an interesting time. Oh my gosh, it's always interesting. But it's just vastly more interesting hearing it from how you put it into these charts and deliver it to us. So thank you for your time. Have a good week.